Welcome Home Radio Podcast. Are you looking to buy or sell your home? Our team is here with answers to guide you through the buying and selling process. We encourage you to ask questions. Please comment on this show or visit us at welcomehomeradio.net for more information. Bringing real estate, lending, and education together in one place, and to help you make the right home decision for you and your family.
And welcome to Welcome Home Radio, where real estate lending and learning come together. It is October 16th, 2024. And we have some of the most interesting 3 weeks coming up, I think, in our nation's history, especially in the finance world. With changes going on in the market, we've got the Fed meeting coming up. And then, of course, oh my goodness, it is a presidential election year. So the next 3 weeks is going to tell a lot about what our economy is doing, as well as who sets and who and what impacts our mortgage rates. That's today's topic. We're going to be discussing who sets them, who designs them, what impacts them, what third non-directional or directional impact those rates. So we're here to talk today. I want to welcome in Thom, Jeff. How are y'all doing today?
Pretty good.
Doing very well, thank you. Very well indeed. These cooler temperatures are wonderful.
Yeah, but they make me want to get out there and play golf instead of in here and work. So it is a challenge. But guys, today's topic is really, to me, at the heart of what we claim we want to help the public do, which is get the CTC, clear to close. And one of the biggest indicators is where mortgage rates are going, where they're trying to go, what impacts them. I mean, Thom, help our listeners understand. The Fed is making some changes. Does that directly impact mortgage rates?
Well, I mean, to answer our question for today about who sets mortgage rates,
Please say no.
Of course, I do.
You set them, right?
Of course I do. Thank you for asking. I surely appreciate it. But going back to the bigger picture where we hear folks oftentimes espousing that the Fed's setting mortgage rates, that's not really the case as far as our real world is concerned. Mortgage rates come from the fact that we look at the Treasury bill rates, which is the basic buying of government debt, and that will then influence and impact what our long-term mortgage rates are as a result of those Treasury bonds that are exchanged in the marketplace that securitize the actual basis, the bottom of the mortgage itself. So that kind of starts us off with the conversation. What makes that adjust? Well, risk makes that adjust according to how markets in the United States, international markets. This is a worldwide type of thing that is used by the world markets to establish how risky do they see borrowing money from the United States, because the United States will pay you an interest rate to borrow money for them to pay their debt with. But if there's not enough people that want to do that, or enough countries that want to do that, it affects our rates up and down. So that's really kind of the nature of the beast when we talk about where do our rates come from. Matter of fact, I was talking about that in my class this morning, so it's kind of fresh on my brain.
Really?
Thom,
And
I have a
what
question
class are
for
you
you.
teaching today?
I'm sorry, go ahead. Sorry, Blair.
Teaching finance today, speaking of an appropriate class to teach on the day we're having this conversation.
Well, help me understand and help our listeners understand. I mean, we saw this morning, Fed Governor Waller was quoted about he's an influential Fed member, he's a voting member, and yet his words are trying to ring true. That's the Fed rate, which is the exchange rate between banks. Why and how does that impact mortgage rates in a positive or a negative way? What does it matter what he has to say when we're looking at VA, FHA, Fannie, Freddie, Ginnie setting rates, or even USDA setting those rates for us for mortgages? Help us get there.
Well, I kind of want to do this in its most pure form if we're talking about what the Fed rates actually do. As you mentioned, they really are setting the overnight borrowing rate for banks as far as what they have to do, making sure they have enough cash on hand to meet their requirements of 5% of their
But Tom,
morning.
I'm interrupting you.
Yes, you are, Jeff.
I'm Jeff Duffy. I'm trying to get a loan to buy my house. I don't care about what those banks are doing. I'm about me.
Good.
Well, how does that affect Jeff Duffy then as he goes about? Because the banks and the feds, they're always going to be doing things. So now
they are, aren't they, Jeff Duffy?
It's never going to change. I can't keep up. But how does it affect me? I want to buy a house in 8 weeks.
Well, I will tell you that it's going to affect you. Either the rates will go up or the rates will go down.
Boy, wow, thank you for solving the ever-loving question for all of humanity.
And think about that. I've used that actual answer now for 30 plus years, and people react kind of like you're reacting.
I want to know if it's a test question on your test.
No, not in the national or the state portion. I just used the crystal ball to figure this out. Ooh, what are they?
You do have a nice crystal ball. I'm close. I'm not there yet, but I'm close.
I get up there and I polish it in the morning and I say, okay, rates are going sideways.
So, but let's look at realistically, the inventory on the market is increasing, which is awesome. We needed that, right? And as an overall,
that's needed for rates. That's needed for house pricing to go down. Yes.
Okay, thank you. That's why I was asking. I want our listeners to know what that's. There's so much discrepancy between. Oh, that means it's a golden market. It's not perfect, but that's a good sign.
Well, let's take a step back, Jeff. You asked a very valid question, and our human what for ball was trying to answer. And
fur ball?
Cue ball.
Cue ball. The interest rate on the bank's trading impacts commercial lending as well as all other things that the banks do, whether it be auto loans, so forth, because it impacts their profit margins. If they're running at a 3.7 borrowing rate, they've got to be at a 4.25 to 4.5 minimum for them to make profit on doing any other loans to you.
Okay.
Now, that's the cash flow. And he went back to risk. It's risk driven. But you have to understand, banks, if you deposit $100, they're going to use $90 and go invest it somewhere, normally into the real estate market, whether it be commercial or residential. But they have to keep 10% of that $100. But then Jeff comes back and says, I want my $100 now, please. Well, they've got to borrow that money between the banks, and they get charged the Fed interest rate to make sure their cash pure for Jeff to be available. Now, if every borrower rushed on the bank, they would not be able to supply every depositor their full accounts. Because they're only required, is it 10 or 20%, Tom?
Well, the value of the asset value of the bank is a 5% number.
A 5% number.
5% number.
Isn't that pretty small?
Well, on $1 billion, how much is 5%?
Well, that's not a small number. No.
And most banks have $1 billion in assets. That's a small bank to not even a medium bank nowadays.
Okay. And I'm only asking as Jeff Duffy because I have no clue. I don't realize what they handle everything. So
we understand that you only work in title. We understand that.
You're my numbers guy, so that's why we're a good team.
So again, how and why that impacts rates is, again, it goes back to what he talked about, the risk model. And it goes back to what we do when we service a loan. Everybody sells those loans and they bundle them in conventional FHA, VA bundles. I don't want to leave USDA out, I'm sorry. Then you have your non-QM, but they bundle them up and sell them to large companies or large mutual funds, so forth. Your insurance, your 401k, all of those types invest into mortgage-backed securities. Now we're bundling, and Tom helped me here a little bit, but we're bundling over 1,000 loans, maybe 2,000, maybe 5,000 loans in a bundle, and they all have to kind of fit together. At what interest rate, how much is borrowed per borrower, all of that, so that they make a return for your 401k, your retirement program, all of that. That's where banks go into investing. And that risk comes back to, what is that risk analysis? And for the last 2 years, I'm going to explain it the Uncle Blair way, is basically we all know you're going to refinance in 2 to 3 years into this mortgage because rates are going to drop. So I'm going to make you pay for some upfront interest rate risk to buy this interest rate. There's no par rate, as they call it, available. Not on any. Now, conventional has started to show par rating, but in the past 2 years, it has not been there. So we've had to buy on to every rate sheet there was. So did I explain it well enough, Tom, or do we need to define it?
I think that's a great explanation as far as our listeners are concerned, to understand the background cost. And risk is, I think you described risk perfectly. If I'm an investor, I know I'm giving you money for a month or 6 months or a year. I actually had one of my students imparting today. They called their loan officer up to refinance the loan they got 5 months ago. And their loan officer said, well, let's wait another 2 months. Because the loan officer wants to do what?
Well, first off, he wants 6 months out.
He wants 6 payments. Otherwise, they're going to what they call claw back his commissions.
Right.
The company commissions, and the company's going to come back to him. So,
and he
is this the same company who's been promoting, hey, gang, refi for free when the rates drop? I mean, is that the same situation, may I ask?
Well, and the free thing, of course, is a very sketchy type of come on in our industry. Because, well, the title.
That's why I'm asking.
Jeff, do you work for free on a refinance?
I never worked for free.
I got my mortgage from you 5 months ago, 6 months ago.
You get a discount, but it won't be free.
You're gonna close it for free, aren't you?
Nope, you get a discount.
What about my
in the first 5 years of you receiving a title policy on the purchase of your home? If you refinance, you get a discounted rate. If it's within 1 year, I'm just telling you from title insurance perspective. In the first year, you get 50%. Then it goes to 40%. Every year after that, it decreases the further you go out. But you do receive a discount. Absolutely. But I don't work for free.
Well, nobody does. And
right.
And that's where
some people are honest and some people aren't.
Exactly. And as people look at continual, it's interesting. We're talking, and where this is going is rates may be dropping. And we can talk real quick. The housing market did a survey, and it was done by John Burns Research Consulting. And what they really did was they were asking homeowners, what rate would they jump into the market? Right now, 13% of Americans said 6.5 to 6.99 they would jump into the market.
I'm sorry, how much? 13?
13% of Americans that responded.
Okay.
47, or right at roughly 50%, that magic mortgage rate was 5 to 5.49. Well, the interesting part about that, if we end up with what the Fed and what Governor Waller talked about was his expectation, even though he doesn't have a glass ball like Tom does, that fortune looks like They're going to cut another 50 basis points this year. So 100 basis points in 2024 and another 100 in 2025. 200 basis points. We should be reaching that 5% to 5.4% interest rate by the end of next year. That means 50% of potential home buyers that do not own a home at this time are going to be jumping in the market. Let's go trickle down economics. If we've got 50% more buyers, I've got sellers that want to move, activity, what's going to do for home prices? Home prices continue to go up because supply and demand. Very
but
simple.
Here's the problem, Blair. We have and spent.
And this is the guy that tested his system.
I know I've got it working. We've got a problem. Yeah, we know what your problem is.
I tested my system.
Did he just? Oh, I thought
going to get.
Totally
I'm right here.
Okay.
That has nothing to do with me.
We'd be able to talk.
How much did you hear? Did you hear me?
Didn't hear you at all.
Okay. So Blair, I'm someone now, Jeff Duffy, going to put my house on the market. And oh, by the way, in the last 18 to 24 months, I bought my house and I paid an extra $60,000 to get that house because we were all battling. What do you say to them?
You're going to have to wait until appreciation catch up. Your payoff. I mean, we're going to see appreciation grow for everyone, but how quickly? Texas is a wonderful place to see that. We see an average of 4.9% across every county. Now, certain counties like Collin have a higher appreciation than somewhere like, I don't know, Clarksdale or Brown. We're not going to see as great appreciation there. So we have to ask the questions, but can you sell your home for at least an equal, if not better? You need to have a plan and you need to talk to an expert about what you can sell it for. And that's where Thom trains those wonderful realtors that give us the insight to what you're going to be able to do that. Now, some people have to wait, like a VA IRRRL right now has to wait. Why? Because the VA requires a return on investment inside of 36 months or less to do a loan, to do a refinance. Now, the IRRRL does not require an appraisal. The IRRRL does not require credit. IRRRL just has to show a benefit of change of rate enough to impact to make it a positive thing. And sometimes that catches, especially with a veteran that has let's say a $250,000 home, and he only owes 170 or 160. He wants to refinance. Well, it's a very small number that he's getting the change with. Therefore, it's going to take squeezing it into 36 months is a difficult thing. But those are guidelines that you have to understand. And what we call it, I call it a trigger lock. I want to look at refinances where what's a good trigger lock for them? Is it 1.5 points move that makes it happen to say, hey, we're ready to refinance your home at a very exceptional rate that will impact your life. But there's some people that have to cash out refinance. Their debt has gone up. Their home is a great value right now. And there's money there to be had if you do a cash out. But unfortunately, cash outs are not like purchases. They are expensive and they will hit you. The loan level price adjustments for cash out rather than buying, or basically rate and term changes, refinancing, is different. And therefore, they are going to hit you with price adjustments that cost money. But they understand you're trying to take the value out of your home. They might be left holding the bag. They've learned their lesson in California where people refinance for 110% of the value of the home and then run and walk away.
I kind of diverted us just a tad, but let's put Thom back on the hot plate. Let's watch him do the chicken dance. But really, I mean, who sets the rates? We started off with this. We started off with the aspect of, and I think right now, and anybody can tell me I'm wrong, and that's fine. We're seeing the inventory grow, which we needed. We houses on the market, but we're not seeing new contracts keep up that market. That the what's the word I'm looking for, guys? They're not keeping up at the same pace. Now, so Tom, my question being is, are we going to get more cuts? I think everybody's thinking it's election year. There's more cuts coming. I don't think we're going to see a whole lot more.
Mortgages are based upon supply and demand. People don't understand that. When we talk about short-term lending, your credit card, your overnight commercial loans, all those things, that's all short-term set up by the Fed as far as the rates, because the banks have to borrow that money to meet their demands, as Uncle Blair mentioned earlier in the conversation. So supply and demand drives our rates for mortgages, which is a different type of market. And I go back to the supply for government debt sets the rates as far as what we see. Will we see a growing demand for debt being purchased by people that want to buy government debt? Probably not, because what? The yields are going down. So the investor has to get a higher spread with yields going down. And as Uncle Blair mentioned earlier, they're now willing to give a little bit back if you give them a higher yield, whereas they weren't willing to do that for the last 2 years, because now we're at this stage of equilibrium, I think was maybe the word you were looking for earlier. In other words, markets go through this rising push, they equalize, they come out, there's equilibrium, then they come down. And as we're now teetering on this coming down part, we're seeing that the yields have dropped off and investors are not willing to bend when they were getting a 7% yield. I mean, they hate this. And I hate it because you go to the banks and they're even more affected. And I bought CDs for the last 2.5 years. And I'm looking at, for the first time, going back and saying, why in the world would I buy a CD now? It's down to 3.75% when it was 5.5%. I mean, that's happened in 60 days. And I'm an old man. I love, real safe, nice CDs. I wish I could have locked that 5.5 in for 2 years, but they were smarter. They caught me trying to do that and said, no, we're going to give you a lower rate if you do that for 2 years. We're not going to guarantee anything.
Well, let's also remember that real estate is a passion. It is a emotional purchase that a couple or a single person, but they make it a lot on emotion. And right now, as I said, the next 3 weeks is going to be very interesting for Americans. If you haven't been in the market, you're not pre-approved already, you're not going to be buying. You're going to wait until the election is over with. You're going to wait to see who's in office. I mean, at least a large percentage of the folks are waiting. In fact, Jeff, builders, you're saying builders are catching up. Where is that? Because builder permits have declined in the last 2 months. They have not increased with this change of mortgage rates.
Isn't that interesting? They're behind. We're based in DFW, but we're across the country, across the world trying to talk to people. But the growth of our area continues. Builder starts, for anybody that means builders buying land and creating lots. Those starts have decreased, but yet they were already behind as far as the growth of this metroplex. So, I mean, it doesn't just happen here. It happens all over. But that's really interesting, Blair, because I have heard that. That's amazing to me.
It is such a challenge right now because builder starts are waiting, permits are waiting. They're seeing where the economy's going. Do we realize that we are still increasing unemployment? What does that indicate? That's another indicator to going, look, we're risk of going into recession if the Fed does not make changes. And you talked about, we're not going to see cuts. We're going to see cuts. Yeah. We're going to see another 50 basis points at least, if not more, because they want to balance
But he asked me about mortgage rates. He didn't ask me about cuts as the Fed is concerned.
Oh,
That's
big difference.
That's a huge difference.
That's kind of why I was
our
leading
topic
into saying we do not, the normal people out here, I do not always understand how those blend. So that's why this conversation is really strong in talking about who creates the rate. So we get off a little bit, but thank you, Thom.
No, we do. And the neat thing is, when I explain it, we get a mortgage rate sheet. What?
You froze for like
4 seconds. And then everything you said came on after you were looking at everybody, and we're waiting for the words to come.
It's okay.
Well, Jeff looked like that, so I understand what you're talking about.
Something about a VA rate sheet.
Well, it's as we look at a rate sheet, we see a spread. We see a rate sheet spread on there, and depending on your credit score, depending on your debt to income, your LTV, all of that impacts loan level price adjustments that bring us into what you can afford, because there are guidelines. And Thom, help our listeners understand, just because the best rate on a rate sheet is 5% doesn't mean your borrower can, even if they had all the money in the world, can't buy down to that 5%, because there are guidelines that state you can't charge but this X amount percentage of the loan to bind down the rate. Is that correct? Or am I wrong?
No, that is an actual qualified mortgage requirement that limits the cost of buyers can pay towards a loan.
But I don't understand why. I've got the money. I can spend $30,000 to get that 5% right now. Why am I being told I can't?
Well, because it says in the qualified mortgage requirements you can't do that.
Who made that determination? That's what he wants to know. Who made the call?
Why can't I have ice cream for the main course? You make all that meatloaf. Ugh, I want ice cream.
Because I'm starting with dessert.
That would be Henry's for Blair. He will always start there and he'll finish there. So, Uncle Blair, if anybody wants to know, just go to Henry's Ice Cream.
Henry's Ice Cream. I'll bump into you.
There's the weakness.
But no weakness.
To answer your question honestly, though, part of it really came about because consumers don't understand the impact they're paying when they're paying. You know, I did a loan for somebody once and they wanted to pay 3.5 points to buy that loan down to about 3.75%, 3.78%. A year and a half later, after they paid 3.5 points to get it down, their rates were at 3.5. If they went to refinance, which they wanted to do, I just said, this is wasting money. You just spent thousands and thousands and thousands of dollars to get your rate down low. So the reason that level was put in with the limitations on how much can be paid towards your financing was a safeguard, a stopgap measure in order to safeguard consumers from going, just like you said, well, I got all this extra money, you know, I won the lottery, let me spend it. No, that's wasted money. You're never gonna see a return on those dollars that you think that are giving you the lowest rate possible, because eventually rates will get down below it.
Thank you. You answered the question before I could ask it. Both you guys know, I was going to say, how much does that really help you on the additional buy down? And it really doesn't. I've been told you're the professionals on that end, so I trust you.
I think the question that's not asked here, that we, you know, a consumer looks at things, we have to understand one question I always ask: how long are you going to stay in this home? If this is your first home, the odds are 97% of first-time home buyers are out of a home in 3 to 5 years. Why would you buy down an interest rate that you'll never make up if that's the case?
So now, is there a correlation? And this is, you know, here's the hearsay. You guys help me with this. We all know they say, right? We lived our lives with that.
So, we hear that a lot.
So for a first-time home buyer, for anybody, but per $1,000, I was told a long time ago, that drops you about $7 a month on your mortgage if you're buying down that rate per thousand. Does that make any sense at all?
Not
And
really.
you can say, Jeff, you're a complete idiot. I just was told that. That's fine. You're shaking your head. Oh, holy cow! Why did I ask the question?
I think a better measurement here is if you spend a point on a 30-year mortgage, it takes you about 5 years to recover the cost.
And what does that point cost?
Well, it depends on the mortgage size.
Obviously, roundabout somebody, one of you.
Well, if you've got a $200,000 loan, you're going to spend $2,000 to save about $37 a month. So how long does it take you to recover that $37 a month? About 60 months.
I think you guys, and I hope for whoever's listening, they call you and ask these questions because those are the things that home buyers get pushed through quickly when you're trying to decide what's best for me and my family. So I hope anyone listening will reach out to you all and make sure they understand the difference. That's why I posed the question.
Let me ask you this, Jeff, then. Where does mortgage rate importance fall on your mortgage? Is it number 1? Is it number 10? Or is it even in the top 10? Because I'm going to tell you, for me, rate's not even in the top 10 of the importance of what a mortgage, what it costs to do, and what's the best one for you. If you're a first-time home buyer needing down payment assistance, is interest rate really the most important thing? Because I said 3 to 5 years, I've seen it. First-time home buyers are out of that home because they're testing. They're finding out what they do and don't like. I like the corner lot. I like neighbors behind me. I don't like neighbors behind me. I don't like a townhome. I want to be out in the country or whatever it may be. They're experiencing. So rate is driven by banks and by people that don't understand what's to sell except to churn a loan. In my opinion, if you understand what a mortgage does in long-term debt, it's the only good liability on your credit report is a mortgage because it appreciates.
And I know we don't have much time left, but I really feel like because we've really hit a point today in that I think the biggest thing is people, especially first-time home buyers, depending on your relationship and who you're talking to, but we enter the prospect of buying a home like a car. And I think so many times people have the wrong concept of, hey, this is what I can afford. And that is the worst way to go about it. You need to talk to the professional. You need to know what your options are, not say, hey, I make this much money, I can afford this a month. Like that's what happens with people buying a car. Guess what? You walked into a trap and you're messed up. And that's car buying. I hope I'm making the comparison that people understand.
I don't like the comparison just due to the fact
I know you don't, but I'm saying mentality of the average consumer.
That's why we need to change the mentality is to understand when you do a long-term debt, a long-term mortgage, let's talk net worth because you've rented, you've lived somewhere else under somebody else's roof, you've not had to pay, whatever the case may be. Now you're investing in yourself. Mm-hmm. And this is a car does not, it depreciates once you drive it off the lot. Everything in your life except a mortgage depreciates. This appreciates. This is growth. This is investment in you. And here's the neat thing is I can show you no matter what interest rate you're at, I can show you how to pay off a 30-year mortgage in 14 years. And it saved me $200,000 plus in interest to pay off my mortgage in 14 years. It was well worth it. It didn't matter what the interest rate was at. It really didn't.
Thank you. That's exactly what I was talking about. People need to realize that don't be hung up on the rate. Talk to a professional. Find the best path for you.
But the scariest part is those that are waiting. Let's say and we're going to talk about it in our next show. I know because those that are waiting are going to see higher home prices and more competition because of supply and demand, as we brought up.
Absolutely.
So, guys, I think we've talked about it. I'm not saying the dog is dead, but we've kicked it pretty good. And I think it's
The dog's never going to be dead.
Dog or the mule?
No, the mule kicks back. I'll just be honest with you. I mean, that's why farmers keep mules around, to get rid of coyotes around cattle.
Absolutely.
So I understand they're invaluable, but I think we've really hit on some good things. I appreciate it. Thank you so much for the time today, and I hope we're helping more and more people get to understand what CTC is all about. And if you don't know what CTC means, clear to close. That means you've reached the goal. You own the home. You're now gaining wealth for your future. God bless y'all. Thank you so much.
Thank you.
Have a great one.
Welcome Home Radio production provided by Lunatic Digital. Check the listing of this podcast for the links to our sponsors. And don't forget to like, share, and follow us on social media. Visit welcomehomeradio.net for more information.
This was a Lunatic Digital production. Visit lunatic